A significant legal and financial confrontation is escalating as New York prosecutors intensify their investigation into the financial history and private dealings of the president. At the center of this inquiry is a massive repository of documented evidence, ranging from bank records and compliance reports to detailed financial timelines. Unlike public narratives or political discourse, these records provide a time-stamped account of transactions and loans that are currently in the hands of investigators. The pressure on the executive branch has reached a critical juncture, as a Supreme Court decision has cleared the way for the case to return to lower courts, effectively maintaining the momentum of the investigation. This legal development ensures that the president may be required to hand over personal tax records to a New York grand jury, a move that aligns the requirements of the office with the standard legal obligations of an ordinary citizen. The scope of this investigation extends beyond simple transaction monitoring, focusing instead on a comprehensive financial narrative. Prosecutors are analyzing how money moved over extended periods, examining every deposit, withdrawal, and transfer to identify broader trends. This process is supported by records obtained from major financial institutions, which include not only numerical data, but also wire transfer details, internal communications, and account statements. By reconstructing these patterns, forensic accountants are mapping financial behaviors to determine if they align with reported income and legitimate business activities. The investigation is particularly focused on identifying discrepancies between the information provided to banks to secure financing and the reality reflected in internal bank documentation. This inquiry is bolstered by existing judicial findings from a New York civil fraud case, which established a documented record of misrepresented asset values. The court found a consistent pattern where higher valuations were utilized to obtain favorable loan terms, while lower values were reported for tax purposes. These findings provide a foundational framework for prosecutors as they transition from theoretical allegations to the analysis of documented facts. By connecting court-verified patterns of behavior with underlying bank records, investigators are examining whether these actions meet the legal criteria for bank fraud. As the case moves forward, the intersection of these financial histories and the documented intent of the parties involved remains the primary focus of the legal proceedings. The core of the current investigation rests upon an extensive archive of records provided by Deutsche Bank, a primary lender that maintained a relationship with the president when other major financial institutions had withdrawn. These comprehensive datasets include long-term borrowing patterns, internal risk discussions, and compliance evaluations, offering investigators a full history of financial behavior. Because Deutsche Bank held a unique position as a frequent creditor, its records provide unparalleled visibility into loan applications, repayment histories, and the internal evaluations that preceded the approval of credit. Forensic analysts are now scrutinizing this data to identify consistency in inconsistency, specifically looking for moments where asset values shifted significantly, depending on whether the objective was to secure a loan or minimize a tax liability. A critical layer of evidence involves internal compliance reporting, specifically suspicious activity reports, mandated under the Bank Secrecy Act. These documents are generated by internal bank teams to flag transactions that may indicate financial irregularities or money laundering. Records suggest a notable contradiction. While the bank continued to issue substantial loans, its own compliance officers were simultaneously documenting internal concerns regarding the client's transactions. This disconnect between the public lending relationship and the internal regulatory filings provides a roadmap for prosecutors. When combined with forensic accounting, these reports allow investigators to determine if the actions taken by the bank and the borrower aligned with the data being reported to federal regulators. Further complicating the legal landscape are recent disclosures regarding significant trading activity in the financial sector. Reports indicate that in 2025, over 170 trades involving financial securities were executed, totaling approximately $20 million. These transactions occurred while federal policies impacting those specific institutions were being actively shaped. However, the required transparency was delayed, as these trades were not disclosed until 2026 ethics filings. Under federal ethics rules, timely disclosure is required to prevent conflicts of interest before decisions are made. The delay in reporting has shifted the investigation's focus toward whether these trades constituted the use of non-public information for personal gain, potentially moving the inquiry from civil discrepancies into the realm of criminal misconduct. As the investigation transitions into its next phase, the focus has shifted to the long-term consequences of these documented patterns and the potential for a definitive legal breakthrough. The longitudinal data provided by years of financial records allows analysts to reconstruct financial behavior with a level of detail comparable to a forensic reconstruction of a crime scene. Beyond the raw numbers, investigators are now examining the internal communications between bank executives and risk managers. These private dialogues are being scrutinized to determine the extent of the bank's awareness regarding potential discrepancies. If these internal records confirm that red flags were raised and subsequently ignored or bypassed to facilitate lending, the legal implications could extend to the institutions themselves, raising questions about corporate governance and institutional accountability. The convergence of the civil fraud findings and the newly acquired bank data creates a significant evidentiary bridge. The New York court's conclusion that asset values were systematically manipulated provides a legally recognized foundation that eliminates the need for prosecutors to prove the existence of a pattern. Instead, the focus has moved to proving execution and intent within specific transactions. This development is critical because, under bank fraud statutes, the submission of materially false information to a federally insured institution is a serious offense. By aligning the court-certified misrepresentations with actual loan applications and the subsequent repayment histories, prosecutors are attempting to establish a cohesive and undeniable link between private financial strategy and potential criminal activity. The final dimension of this investigation involves the intersection of private wealth and public policy. The delay in disclosing the $20 million in financial sector trades has prompted a rigorous review of federal ethics frameworks. Because these disclosures reached the public record only in 2026, after the relevant policies had been implemented, the preventive function of transparency laws was effectively bypassed. This timing has led to increased scrutiny over whether personal financial benefit was a factor in official decision-making. As the grand jury continues its review of these records, the outcome of this investigation stands to redefine the standards of financial accountability for the highest levels of government. For more updates on this developing case, subscribe to our news alerts as more documents become public.